Are you looking for high-yield dividend stocks? This is a question that resonates with many savvy investors. High-yield dividend stocks are like the hidden gems of the investment world. They not only provide a steady stream of income, but they also offer the potential for capital appreciation. In the universe of high-yield dividend stocks, there are 7 that stand out from the crowd. These are Pfizer, Realty Income, Orange, United Microelectronics, Gerdau, Hafnia Limited, and Copa Holdings. Each of these stocks has its own unique set of characteristics that make it a potential powerhouse for income investors. From the healthcare giant Pfizer to the telecommunications leader Orange, from the tech titan United Microelectronics to the steel industry stalwart Gerdau, from the tanker operator Hafnia Limited to the airline Copa Holdings, and let's not forget Realty Income, the company that prides itself on being the monthly dividend company. These are the 7 stocks we're going to delve into today. We'll discuss their current performance, dividend yield, payout ratio, and growth potential. So, if you're eager to learn more about these high-yield dividend stocks and how they can potentially boost your portfolio, stay tuned as we dive deeper into each of these stocks. First on our list is Pfizer. As one of the world's leading biopharmaceutical companies, Pfizer's performance has been nothing short of impressive. With a robust portfolio of medicines and vaccines, it's no surprise that this company has been a steady performer in the market. But let's talk dividends. Pfizer's high dividend yield is certainly one of its shining features. This yield, which is a measure of the annual dividend per share divided by the price per share, is an attractive proposition for those looking for steady income streams. Now, let's move on to payout ratios. Pfizer's payout ratio, the percentage of net income that is distributed to shareholders in the form of dividends, is another factor that makes it a compelling option. This ratio is a testament to Pfizer's commitment to returning value to its shareholders. But what about growth? Well, Pfizer's potential for growth is certainly not to be overlooked. With a strong pipeline of innovative medicines and vaccines, the company is well positioned to continue its growth trajectory. Further, the company's recent developments, including its role in the global COVID-19 vaccination effort, underscore its capacity for innovation and growth. And speaking of recent news, Pfizer has been making headlines for its advancements in the healthcare sector. From new drug approvals to the expansion of its vaccine portfolio, there's always something exciting happening at Pfizer. So what does all this mean for you? Simply put, Pfizer's solid performance, high dividend yield, and strong growth potential make it a worthy contender for your investment consideration. With a solid track record and a future filled with promise, Pfizer certainly has a lot to offer. Clearly, Pfizer is a stock that deserves your attention. Whether you're looking for a steady income stream or potential for growth, Pfizer offers it all. So, as you consider your investment options, Pfizer is one that you'd do well to keep on your radar. Next up, we have Realty Income. Realty Income is not just a name in the real estate industry, it's a promise of steady cash flow for investors. Known as the monthly dividend company, Realty Income boasts a track record of over half a century of uninterrupted monthly dividends. This is a company that understands the power of consistency and reliability, 2 factors that income investors often value highly. Let's talk about performance. Realty Income has a history of steady growth, with its portfolio expanding from just a handful of properties in the late 1960s to over 6,000 today. This growth has been mirrored in its stock price, with shareholders experiencing a compound average annual return of around 15% since the company's listing on the New York Stock Exchange in 1994. But what about dividends? After all, that's what we're here for, right? Realty Income shines in this area too, boasting a high dividend yield of around 4.5%. This is significantly higher than the average dividend yield of the S&P 500, making Realty Income an attractive option for income-focused investors. Now, let's move on to the payout ratio. Realty Income has a payout ratio of approximately 82%. Some might see this as a red flag, as it suggests that the company is returning most of its profits to shareholders rather than reinvesting in growth. However, given Realty Income's business model of owning and leasing out commercial real estate, this high payout ratio is not necessarily a cause for concern. Finally, let's consider growth potential. Realty Income's future growth prospects look promising thanks to its focus on acquiring high-quality retail properties leased to leading service and retail businesses. The company's commitment to diversification also bodes well for its future growth, as it reduces the risk of any single tenant or industry impacting its overall performance. In recent developments, Realty Income has continued to execute its acquisition strategy, adding more properties to its portfolio and increasing its geographic and tenant diversification. This proactive approach to growth, combined with its historical performance and high dividend yield, makes Realty Income a compelling choice for income investors. Realty Income is indeed a sturdy dividend stock to consider. Welcome to Money Minds. Moving on, let's discuss Orange. This multinational telecommunications corporation has its roots in France and has been a prominent player in the global market for decades. Orange's current performance is something to behold. Despite the challenges presented by the global economy, Orange has shown resilience and adaptability, maintaining a robust position in the telecom industry. Let's talk numbers now. The dividend yield offered by Orange is quite attractive. It's hovering around the 6% mark, which is a strong figure, particularly when you consider the current low-interest environment. This impressive yield stems from the company's commitment to returning value to its shareholders, an ethos that has been a constant throughout its history. What about the payout ratio, you ask? Well, Orange's payout ratio is in line with its industry peers. This indicates that the company strikes a balance between rewarding its investors and retaining sufficient earnings for future growth and expansion. It's a delicate balancing act, but one that Orange manages well. Now, let's touch on the growth potential. Orange is investing heavily in cutting-edge technologies like 5G and cloud services. These investments are expected to drive future growth and enhance the company's market position. Moreover, Orange's continued expansion into emerging markets indicates a forward-thinking strategy and a commitment to growth. In terms of recent news, Orange has been making headlines with its sustainability initiatives. The company is making strides in reducing its carbon footprint and promoting sustainable practices, which is not only good for the planet, but also adds to Orange's appeal to socially conscious investors. So, to wrap up, Orange offers a tantalizing mix of strong performance, an attractive dividend yield, a balanced payout ratio, and promising growth potential. And let's not forget its commitment to sustainability, a factor that's becoming increasingly important in today's investment landscape. Orange is certainly a dividend stock with potential. Fourth on our list is United Microelectronics. This company, based out of Taiwan, is a global leader in the semiconductor industry. The company's operations span the globe, and it has been able to maintain a steady performance, even in the face of a challenging global economy. United Microelectronics boasts a high dividend yield. This is an indicator of the company's commitment to returning value to its shareholders. The company's strong cash flows and robust financial health have allowed it to maintain a high payout ratio. This means that a significant portion of the company's profits are being returned to shareholders in the form of dividends. For those who prioritize steady income, this could be a key factor to consider. In terms of growth potential, United Microelectronics is well positioned for the future. The company has been making strategic investments in research and development, positioning itself for growth in the rapidly expanding semiconductor market. As technology continues to advance, the demand for semiconductors is only expected to grow. United Microelectronics stands to benefit from this trend. Recently, there have been several noteworthy developments for United Microelectronics. The company has been forging new partnerships and securing contracts with major tech companies. These deals not only provide a steady stream of revenue, but also strengthen the company's position in the market. In conclusion, United Microelectronics combines a strong track record, a high dividend yield, and promising growth prospects. For those seeking a sturdy income stock with potential for capital appreciation, United Microelectronics could be a valuable addition to your portfolio. Next, we turn our attention to Gerdau. Gerdau, a prominent player in the steel industry, has been making waves with its impressive performance. Hailing from Brazil, this company has a strong presence in the global market, boasting operations in over 10 countries. The company's robust performance is reflected in its financials, making it a compelling choice for income investors. Let's delve into the numbers. Gerdau's dividend yield is quite attractive, standing firmly at around 6%. This figure is a testament to the company's commitment to returning value to its shareholders. Moreover, this yield is backed by a solid payout ratio which hovers around the 50% mark. This demonstrates that Gerdau is managing its earnings effectively, ensuring a steady flow of dividends without compromising its financial stability. But what about its growth potential? Well, Gerdau's prospects look promising. The steel industry is projected to grow steadily over the coming years, driven by increasing demand in sectors like construction, automotive, and infrastructure. Gerdau, with its well-established market position and operational efficiency, is well-positioned to capitalize on these trends. Recently, Gerdau has been in the news for its strategic initiatives aimed at enhancing its operational efficiency and sustainability. The company has been investing in technology and innovation, aiming to reduce its environmental footprint and improve its production processes. Such forward-thinking strategies not only boost Gerdau's profitability, but also enhance its reputation as a responsible corporate citizen. Taking into account these factors, the attractive dividend yield, the healthy payout ratio, the promising growth prospects, and the company's commitment to innovation and sustainability, Gerdau emerges as a strong contender for income investors' portfolios. Gerdau is definitely a stock income investors should consider. Sixth on our list is Hafnia Limited. Now let's pivot our attention to Hafnia Limited, a titan in the world of international shipping. Hafnia is a leading product tanker company that operates within the crude oil and product tanker sectors, providing transportation services worldwide. At present, Hafnia Limited is demonstrating a robust performance in the market. Its current performance is characterized by a healthy balance sheet, strong cash flow, and a solid track record of profitability. These factors not only make Hafnia a stable investment, but also a lucrative one. What makes Hafnia Limited stand out among the crowd is its high dividend yield. The company is known for its generous payouts, making it an attractive choice for those seeking a steady income stream from their investments. Currently, Hafnia Limited is yielding around 6%, a figure that far surpasses the average industry yield. Now let's talk about the payout ratio. The payout ratio is a crucial factor to consider when investing in dividend stocks. It gives us an idea of what portion of the company's earnings are being paid out as dividends. Hafnia Limited has a sustainable payout ratio, ensuring that the company can maintain its dividend payments without jeopardizing its financial health. The company's growth potential is yet another reason why it's worth considering for income investors. Hafnia Limited has been consistently expanding its fleet, enhancing its operational efficiency, and exploring new market opportunities. These strategic initiatives are expected to fuel the company's future growth and, consequently, its dividend payouts. Recently, Hafnia Limited has been in the news for its proactive approach towards sustainability. The company has been investing in greener technologies and practices, aiming to reduce its environmental footprint. These initiatives not only make Hafnia a responsible corporate citizen, but also position it well for future regulatory changes and market trends. Hafnia Limited is a promising dividend stock. Its combination of a high dividend yield, sustainable payout ratio, and growth potential make it an appealing prospect for income investors. So, if you're looking for a sturdy dividend stock that can provide a stable income stream, Hafnia Limited should be on your radar. Finally, we have Copa Holdings. This company is a major player in the Latin American commercial aviation industry, and it's been making some impressive moves in the market recently. Copa Holdings has been consistently performing well in the past few years, and the current year is no exception. The company's strong operational efficiency and strategic initiatives have helped it maintain steady growth even amidst the challenging economic environment. Looking at the dividend yield, Copa Holdings is a standout. With a yield hovering around 6%, it's certainly on the higher end of the spectrum. This is great news for income investors, as it means a higher return on investment. Now let's talk about the payout ratio. This is a critical factor to consider when you're looking at dividend stocks. It's essentially the portion of earnings a company pays out to shareholders in dividends. For Copa Holdings, the payout ratio is quite sustainable, suggesting that the company is not overextending itself to provide dividends. But what about growth potential? Well, Copa Holdings has a lot going for it in this department too. The company has been able to expand its network and increase its passenger traffic, which is likely to drive its future growth. In terms of recent news, Copa Holdings recently announced plans to expand its fleet and strengthen its position in the Latin American market. This is an exciting development that could significantly boost the company's growth and profitability in the coming years. In summary, Copa Holdings is a high-yield stock that income investors might find appealing. The company's strong performance, attractive dividend yield, sustainable payout ratio, and promising growth potential make it a compelling option for those looking to generate a steady income from their investments. Now that we've analyzed each stock, let's summarize our findings. We started our journey with Pfizer, a powerhouse in the pharmaceutical industry. Its consistent dividend yield and robust performance make it a strong contender for any income investor's portfolio. Next was Realty Income, a real estate investment trust that has been steadily rewarding its investors with monthly dividends. Its long-term stability and high yield make it a reliable income source. We then looked at Orange, the telecom giant. Despite the competitive market, Orange has maintained a steady dividend payout, making it an attractive option for those seeking consistent income. United Microelectronics came next with its solid semiconductor business. Its performance and favorable payout ratio position it as a compelling choice in the technology sector. Gerdau, the steel industry titan, was our fifth stop. Despite the cyclical nature of its industry, Gerdau's attractive dividend yield and commitment to shareholders make it a worthy consideration. Our penultimate analysis was on Hafnia Limited, a lesser-known player in the tanker industry. Its high yield and growth potential make it a dark horse that could potentially bring substantial returns. Finally, we discussed Copa Holdings, an aviation company that has managed to maintain a respectable dividend yield. Its resilience and commitment to shareholders have earned it a place in our list. Each of these 7 stocks brings something unique to the table. They all have strong fundamentals and have demonstrated a commitment to returning value to shareholders through dividends. This makes them all potential candidates for your income-focused portfolio. However, it's important to remember that investing always carries risk. These stocks, while promising, are not a guarantee of future returns. It's crucial to do your own research, understand your risk tolerance, and make informed decisions. Remember, investing in high-yield dividend stocks can be a good strategy for income investors. Do your research and make informed decisions. Happy investing!